Welcome to Idea to IPO. Hello, my name is Rob. I organize Idea to IPO. We've been holding events in Silicon Valley for many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 100,000 members among all our meetup groups all around the world. We've organized, promoted, and produced over 2,531 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, networking events, and more. These days, we're 100% online. We have an event nearly every day of the week. Check out our schedule at ideatoipo.com. At this point, I'm going to hand it off to our distinguished moderator, Jason Putnam Gordon. Jason, take it away.
Good afternoon. Thank you very much, Rob. I'm Jason Putnam Gordon. I'm a shareholder at Polsinelli in our Venture Capital and Emerging Growth Companies group. We've got a fantastic panel today with Ephraim Lindenbaum from Advanced Ventures, AJ Chopra from Trinity Ventures, and Carolyn Funk from Blue Bear Capital. Today's topic is going to be what to expect in 2021 in venture capital. Now, before we move into that, what I'd first like to do is have you fill out our audience survey poll. It's very helpful for us to understand who is going to be in the virtual room today. Additionally, I want to remind you that this is being recorded. So the upside is if you miss some or all of it, so long as you've registered, we'll send you a copy afterwards. Downside is if you say something that you want to keep confidential, that's not going to happen because it's going to be recorded and shared for posterity. Recorded for posterity and shared with the rest of the group. So be mindful of what you're asking for. If you have a question, we'll encourage that. Please use the Q&A function, not the chat function. It makes it easier for me to manage because not only am I moderating, but I'm also running all the tech in the background. So with that, I'm going to end the poll in another moment. But before I do, what I want to do is go around the horn, have each of our distinguished guests here today describe who they are, what types of investments they make, and what they've seen in 2020 to lay some context for our discussion on what to expect in 2021. We'll start with you, Carolyn. Your mic is muted. There you go.
Hi, everyone. Thanks for joining and spending your lunchtime with us here in the panel. Great to be here again. Rob, thanks for organizing. Yeah, little background about myself. I spent the last 16 years working on topics related to energy in the broadest sense. Started off in Germany, that's where the accent is from, working on research and policy with German government, German utilities. And then here in the Bay Area, worked at Siemens for a number of years in their group that's now Next 47, investing in startups in the intersection of the digital and industrial side. Have been a startup operator myself, COO, head of operations, and now on the venture front at Blue Bear Capital. At Blue Bear, we're specifically investing in software and data technologies for the energy and industrial supply chains. So B2B, SaaS and data. We invest in companies that are post-revenue that can mean multiple different things, usually C to Series B, usual check size is 1 to 5 million. And we support growth through our network largely from the energy private equity world. Geographical focus, North America and Europe. Happy to dive deeper into any of those as we continue.
Well, terrific. And do you have any observations that you want to share from 2020? What did you see that you expected or didn't expect?
Yeah, so very important for our field. Of course, there is kind of that regulatory environment. There was a little unclear last year. That's cleared up as of yesterday more. Some technological trends that we've been seeing last year is just a lot of more geospatial data deployed into all sorts of different businesses. We saw a lot more on the ESG front. So really tracking emissions, tracking general ESG metrics. And I think that was probably the biggest trend in 2020.
Terrific. Well, we're excited to have you on the panel. And just moving to your right, as I'm looking at my screen, we've got F.
Great. Thank you very much, Jason. And thank you very much, Rob. Always great to be on IPO panel here as well with Carolyn and AJ as well. So my name is Ephraim Lindenbaum. I'm the Managing Director of Advanced Ventures, but at heart, I'm a recovering entrepreneur. I started and founded a company here in Silicon Valley and grew that through the 90s. It's 7 countries, 350 people, and got ready to go public with our S1 filing time period of kind of the first .com boom, if anybody remembers that. And just as we were getting ready to go out, a M&A offer came in. So dumbest guy you ever met for not going public in the .com boom. A couple years later, smartest guy you ever met. But from a venture perspective, you know, when an entrepreneur exits here in Silicon Valley, it's somewhat binary. You either start your next company or become an entrepreneur, an investor. You know, as I like to joke, I didn't have any great ideas at the time, so I had to default and become a VC. But in reality, I was part of a team that spun up Advanced Ventures in 1999. We're one of the last remaining 99 vintage maiden funds out there. We've now invested across 3 funds and at the tail end of our 3rd with a 4th managed co-fund as well. We invest broadly across technology, health, and wellness. For us, that means more traditional technology that everybody tends to hear about in Silicon Valley with a real focus around fintech and health tech. But we also invest around categories like food, beverage, as well as food, agriculture, for example. We've got great companies in the CPG side with plant-based foods, for example, that you can go to your local Safeway and purchase here in Silicon Valley or around the world. But moreover than that, you know, we've really prided ourselves as a firm at being very entrepreneur-centric. We invest in the earlier stages of a company's growth. So historically, we were first institutional money in our early phases of the 20 decade. But today, we're very much what you'd call late seed and Series A. We typically invest alongside other entrepreneurs and with entrepreneurs and alongside other VCs. And to a large degree, you know, the market's really evolved to the point where we do look for companies that have not only a minimum viable product, we do look for revenue, we do look for customers out there. And as we look at the broader spaces like food and agriculture, those are different dynamics than traditional tech, but certainly we look for many of the same markers there. You know, so that's a good overview of Advanced Ventures.
Well, fantastic. And are there any observations that you'd like to share with what you saw in 2020 and that you expected or didn't expect to see? Yeah.
Yeah, certainly. Well, you know, I think the overarching factor is the adaptation, right? Similar to the way that we saw a lot of companies here in Silicon Valley adapt to remote, you know, work very quickly. You know, certainly, I think the venture space has done that. You know, we had this panel back in March or April of last year, you know, and then again in the fall, and you know, I think there was a tremendous amount of uncertainty around how this market would adapt, how we as VCs would continue to fund. I think there have been significant trends that have developed that we've seen. You know, number one, later stage deals have gotten a lot more interest. I think, you know, from a venture perspective, there's a de-risking factor that we like to see. There's a, you know, comfort factor that we have that other venture folks we know have already invested. I would say the number one challenge amounts to the typical in-person sort of VC gut check. You know, there tends to be a lot of, you know, one-on-one with entrepreneurs that we pride ourselves in the venture space as being part of the, you know, investment process. You know, that was not possible for much of this year. However, you know, I think we found ways to work through that. You know, in our case, you know, many of our deals come from other VCs. I think we rely on that, and that's how we saw much of the late stage deals getting done. But you know, just looking at some of the core metrics that are out there, you know, PitchBook and NVCA, that's the National Venture Capital Association. You know, this was a banner year 2020 for venture capital, $156 billion plus invested. $290 billion in exit value with the IPO market, and $73 billion in raised by VC funds. That's us and our money that we tend to invest. So, you know, really it turned out to be a phenomenal year from a venture side. And I think it brought a lot of the promise that we hoped for. We had telehealth companies that, you know, really made a big difference. Diagnostic companies doing tests for COVID. So, you know, I think a lot of the companies stepped up and really were able to make a difference.
That's terrific. And last but certainly not least, AJ.
Hey everyone, thanks for having me on. I'm also a reformed entrepreneur, to borrow from F's phrase, but I actually took my company public, so was lucky enough to write that to several $1 billion in market value, and then sort of went to the dark side of venture capital with Trinity Ventures. We are a $1.5 billion AUM fund, early stage, primarily Series A's and Series B's. We do a bunch of seeds as well. The company's got a long history. I joined about 15 years ago, but the company actually was the original funder of Starbucks and Jamba Juice and P.F. Chang's on the consumer side. So about 30% of our business is consumer. Obviously, that's moved all to online companies such as Fitbit, ThredUp, Bulletproof, and Turo. And then we have a very robust set of companies that we funded at very early stage on the B2B side as well, including New Relic, Outreach, Cohesity, ServiceMax, all of these unicorns. So that's kind of like about the fund. So we look for, entrepreneurs that are in SaaS sectors, in vertical SaaS in particular, is kind of like a focus. Direct to consumer brands are of interest to us. Marketplaces like ThredUp and Turo are of interest to us. In terms of observations, I agree with F. I mean, to be honest, 2020 was a big surprise to me. I think probably to a lot of people, when kind of like March happened, we thought the world's going to fall apart. Didn't know where anything is going to go. And I remember reporting the results of our June numbers. And already in June, looking at March and then April and then May and June, already in June, we were starting to see the beginnings of the V-shaped recovery. And by August, it was like fully recovered. And by the way, I'm not thinking of the stock market. I'm thinking about the P&L of our 65 portfolio companies, okay? So it was stunning. And I would say it was a tale of two cities. Those companies that were in SaaS, enterprise or mid-market, as well as D2C, e-commerce companies, flourished. Some of our e-commerce companies that are direct to consumer had record years, by the way. And then companies that were servicing SMBs actually suffered quite a bit. And I would say their recovery was probably more U-shaped, but they did come back strongly in Q4. I mean, I'm just looking at Q4 numbers now, and it's pretty stunning how those companies came back. And then also, as F mentioned, I mean, in March, I would not have thought this would be a banner year for venture capital with over 150 billion invested. But it was also a tale of two cities. I mean, if you look at where the money went, it was almost all in late stage, okay? So roughly about 60% of the dollars went into late stage. There was a good amount of money that went into seed because seed investments are easy to do. But as was mentioned previously, Series A's and that level, the dollar volumes and even the deal volumes went down quite a bit, which is not surprising because you need to sort of get to know people and meet them and so forth before you make that decision to write a $10 to $15 million check at Series A's and Series B's. So that was kind of like the dynamic. It was I would say it was to me, it was a very, very interesting year in every form, right? In every form as to what was happening with the pandemic, the political ecosystem, the entrepreneurial ecosystem, the stock market, and so forth. It'll probably be studied for many, many years.
That's terrific. So what I'd like to do at this point is I'd like to, now that we've had a chance for the audience to get to know the panelists a little bit, I want to let the panelists know who's in the audience. So about 26% of the audience is here in the Bay Area, 13% is in California, close to 20% is elsewhere in the US, a few folks from the rest of the US, 20% in Europe, 6% in Asia, 3% in Africa, and 1% in Australia. So we've got a good mix. And then again, this is recorded. So lots of, more people signed up than are attending. So this will be seen throughout the world, which is fantastic. And I think that we've got, I just lost it, unfortunately, polls. In terms of who's in the room, 40% first-time entrepreneurs, 10% serial entrepreneurs, a few angels, a few VCs, 20% of the folks are at a startup, And then we got some folks from the government and some folks from elsewhere. So I'll share those results. And what I'd like to do is maybe pick up on a common thread. AJ, you mentioned the Tale of Two Cities in terms of capital predominantly going, or the bulk of the capital predominantly going to late stage, with a number of seed stage deals being done, but the Series A kind of winnowing out a little bit. And that, I think, jives with what I've seen, and obviously the rest of the market trends as well, and also kind of mixes in with what F was mentioning before, which is, you know, the venture community is still able to do deals. And, you know, how has that how has that sort of changed, and what do you see coming down the pike in 2021? Can't believe I'm saying 2021, but 2021 as to sort of those Series A folks and their deals, and you know what COVID means for that. We'll start with you, AJ, but it's really an open panel discussion.
You know, I think we look at our own deal pace, and you know, it's really all a matter of getting comfortable with a new way of doing things, right? And in some cases it takes longer than other cases. If you're looking at a company that's already well into revenue, let's say 20, 30 million in ARR, and it's got a good traction, so forth, you can make a bet based on, you know, those metrics and reputation of founders, the type of investors that are involved, so forth. The tricky thing about Series A is that it's that stage where, you know, the seed investors have made a bet at low, typically relatively low valuations, and sometimes based on personal connections and so forth. But the Series A investor who, let's say, does not know the entrepreneur from the past. If you know the entrepreneur from the past, different equation. But in most cases, we're looking at fresh people that we have not invested in or interacted with before. In that instance, you know, getting to know them is the tricky part. But I have to say, when I look at the engagements we have been doing, we ourselves as investors are getting more and more comfortable doing that virtually. And in my case, you know, I started going to the office just by myself, you know, so I could be socially separated and invite the entrepreneur to come in. And actually more recently, I found it to be more effective to just do it in my backyard and do it outside, which is safer. So you can take your mask off and actually have a beer, let's say do it in the evening or something. And, you know, have a more personal interaction, right? And kind of like get to know them more as individuals and people rather than just entrepreneurs. Hear their real story, you know, rather than just the story of the company. So I think people are getting more and more comfortable. So I believe that you know, that pace will pick up even before the vaccines and so forth, just because people are getting more used to doing business that way and getting more and more comfortable with it.
Carolyn, how's your experience been? Do you share the same sentiments?
Yeah, we've actually had the same investment drumbeats in last year than the years before. So we make about 4 investments per year, 4 to 5, and I totally agree with AJ. There was kind of that gap in March, April, May, where there was a little more uncertainty, both in terms of customer growth, but also in terms of investments. I think from my perspective, we've seen a record year for investments in climate change technology in the broadest sense, however PitchBook defines that. There have been 16.4 billion invested in that sector last year, surpassing 2018, which was kind of at the same level. And I think we're going to see that grow even more this year. So it's been busy. It's been competitive, and having a deep network is really important to get to those entrepreneurs at the right point. We've done everything remotely this year. I mean, there were some deals at the front end of 2020 where was kind of closing on folks that we had met before. But yeah, we've made multiple investments fully remote. And I think the biggest thing is it's great if people are here in the Bay Area and we can meet them. That's great. You can meet for a walk. But I think that 2020 has also showed that the international and just geographical expansion is possible. Seeing a lot more going on in Europe. and actually growth and interesting companies coming from there and getting easier access to capital here. So more of a mix. Some of the larger funds also launching Europe funds, so that kind of nurtures that collaboration. And then on just geographically supporting founders who are, I don't know, somewhere in North Carolina or in upstate New York and Florida. It doesn't really matter to us. It didn't matter much before. It was just like recency and immediacy bias. But I think that's made it more interesting and diverse.
F, do you have anything to add?
Yeah, certainly. I agree with what both of my colleagues have said. I think it's certainly super interesting how we've adapted. I think at the end of the day, if we didn't adapt as I think we've shown we have, it's really one of those classic analogies. The dogs have to eat the dog food. We've sort of preached all this new technology for many, many years, and certainly seeing how quickly we've adapted to that is certainly a baseline, I think, versus an accomplishment in venture. We've been investors across the US and certainly globally for a long period of time. I think the evolution of tech is really what's been exciting there. Historically, we've had to sit in our conference room with teleconferencing systems. Today it's on your mobile device, your laptop, et cetera. It makes it super easy. Although we do focus clearly in North America today, we do have companies in our portfolio outside of the Valley. In fact, a majority these days of companies are now getting close to being outside of the Valley. We've strong concentrations in Colorado, Arizona, et cetera. So, a lot is done remotely anyways. So the ability to invest further, in the remote stand is really been comfortable for us. Most of the one thing I will say is deal sourcing, right? We are not necessarily a, sort of forward-facing deal sourcer. We get a ton of incoming, some of that's great. Folks like yourself, Jason, are our best deal sourcers. I always like to say, there's a natural filter associated with, high quality service providers like yourself, meaning that if you send us garbage, we'll never, return your email. So great value there. That's where we get our deals. So for us, a lot of this has been, easy. When we get to actually executing on the check, we tend to invest in syndicates. So, today, a lot of our deal flow is just coming from other VCs. When you've invested alongside folks for 5, 10, 15, even 20 years today, there's an inherent trust level. We get to know each other, even in this COVID environment on events like this. If I added up all the folks I've met, co-panelists over the course of this last year, it's probably like just going to a bunch of big venture events. So, it really has turned out to be effective. Maybe we've had even more time to get together instead of driving to coffees and parking your car in Palo Alto and trying to find your way there. Just being able to do it on Zoom has been super effective. So, I think we've embraced this change. I think it's worked well. Certainly folks like AJ, have been able to find a way to get it done in person. Carolyn coming in on a more global VC front has sort of always done that. And I think we've just kind of fit into the middle ground.
That's terrific. So at this point, what I'd like to do, because you mentioned sort of sourcing, we haven't done this before today, but usually what we do early on is, to the extent any of you want to be contacted by any members of the audience, what's the best contact information? If it's, if you're not looking to be contacted, that's a completely legitimate answer as well.
Yeah, I think the easiest way is just LinkedIn for me. So Carolyn Funk should be very easy to find. You can also send me an email directly. That's Carolyn at bluebearcap.com.
Yeah, for me,
just
go ahead.
Sorry, go on, AJ.
Oh, I was going to say that for me, it's probably best to just DM me on Twitter at Ajay Chopra.
Yeah, certainly. And, I agree with Carolyn. LinkedIn is certainly best. I mean, the ultimate way to get through, to be frank with you, is, going through a trusted service provider. If you don't have, your sort of legal counsel teed up as a startup, go get one. Jason's phenomenal. I mean, in fact, we use his firm on, a totally different component as well on the lobbying side. One of our portfolio companies that, Jason referred to, one of their great lobbyists in DC, helping our company through the morass of COVID EUAs and the FDA right now. So, trusted partners, folks like Rob, as well are great for us. That's how we get deal flow. We look to them to provide that initial filter. Then from there, as AJ said, you can DM us on Twitter, certainly on LinkedIn. I encourage you to follow us on Twitter. It's a great way to find out what we're thinking. Certainly, it sounds like AJ's active there. I mean, this is the first time an entrepreneur can really see what we're thinking at any given basis. Historically, we're putting out tweets every 24 to 48 hours, and that really comes from the internal side of like, what are we thinking about this week? So it's super helpful for entrepreneurs to understand us.
Thank you, Evan. Thank you for the plug. That was not planned, although always appreciate it. So
you guys are doing great work. If you weren't doing great work, you wouldn't get the plug. So you get a great plug.
Well, thank you. So what I'd like to do is maybe stick on that theme briefly and just reiterate something that I heard, which is, sounds kind of like the pandemic has in part made the world a little bit flatter in terms of capital flow, but in terms of deal sourcing, it still is based, or there's some tension there in terms of it being relationship based. So one of the predictions that we hear and I read about in the press from all the time is that's the downfall of Silicon Valley and the downfall of the Bay Area, and venture is going to move everywhere else. Does anyone expect to see that happening in 2021? And if not in 2021, shortly thereafter?
Yeah, I think the demise of Silicon Valley is overblown. I think that the fundamentals here is as follows. If you look at where all the dollars come in from for investments globally, from endowments and pension funds and family offices and fund of funds and large corporations and so forth that have got dollars to deploy. I mean, they have to look at alternatives that will yield returns. And in the current climate, there are very few alternatives to either public or private investments. I mean, you can bet on Bitcoin, but the market cap of Bitcoin is not large enough, even now, that it can absorb those dollars. So there's no yield anywhere else. So basically, I think if you start with that premise, there's lots of dollars coming into the public markets, which are at all-time high, and therefore into private markets, because there's even more to go around. So what that means is the entire ecosystem is going to expand. And it's delightful to see other ecosystems emerge, like Austin and Miami. Seattle was always strong. LA has been strong for many years. New York has been extremely strong for several years. And now Miami, maybe, with all this stuff, all the buzz about Miami, maybe it'll be a strong ecosystem. So I think what happened is the dollars are growing. And I think especially with what happened in the pandemic, it's not just the access to venture capitalists has flattened, but access to dollars is also flattened as a result of that. So I think if you're sitting somewhere, even internationally, right, and you have the right idea that can produce a product with global interest in particular, those dollars are going to be available. And by the way, maybe Carolyn can speak to the ecosystem in Europe. I mean, I've been in Berlin and France, and I mean, Berlin is an incredible ecosystem that is developing. We don't invest a lot in Europe. We just have a couple of investments, maybe 3 or 4. So, but every time I've been there, I see it looking more and more like Silicon Valley, by the way. So I don't think it's not a zero-sum game, right? It's never been a zero-sum game. So I think, and particularly as the dollars are growing and there's a lack of opportunity to invest in other asset classes like bonds or even real estate right now is going to be challenged for a while. I mean, it's all going to flow into equities, both public and private equities, basically venture, right? So there's some in buyouts, but like venture is going to be a pretty large part of it. So I just think that Silicon Valley is going to be robust and strong for a very long time, and other ecosystems will develop and become stronger and stronger over time, which is great for entrepreneurs. It's terrific for entrepreneurs.
And Totally agree, AJ. To add to that, what is also great for entrepreneurs with some of those larger corporates, and I'm including Google and Facebook into that, going, actually not Google, Facebook and Twitter and some others. People, engineers are, I think, are starting to look around, where can I in the near future work in a small team and work in an office, because we're social animals. We will go back to meeting each other and having beers and drawing out ideas on a whiteboard in a room all together. So I think for startups, providing that flexibility to their employees, maybe some will be fully remote and more have, like, I don't know, team meetings once a quarter, and others are going to have that little office space somewhere in Soma, and people are cramped into a small space, and that will actually be a way to attract people out of kind of the larger companies.
Yeah, I kind of, generally, agree with both of my colleagues here. I mean, I think what's interesting is, to AJ's point, the demise of Silicon Valley is, greatly overblown. It's been continually done. Having, being one of the few people who actually spent a lot of my youth in Silicon Valley, I'm as close to a native as you get here. I remember, and having started my first company, in my teens, and my second, which grew into ultimately the company that I exited with when I was 18 years old, I could tell you that, dating back to the late 80s, there was a collapse, an early 90s collapse, a mid 90s collapse, the great .com collapse, and then, certainly the housing collapse and the 08 period. And at the end of the day, frankly, there are a number of things. I think, the Valley as a whole was overdue for a correction. The Valley historically has had a 4 to 8 year max corrective cycle. It's important. As John Chambers back in the day at Cisco said, you've got to peel off 10 to 15% to at all times to keep it fresh. That lets more oxygen into the room with exits and entries. I think that was something that had to happen here. But at the end of the day, to AJ's point, if you look at the global concentration of early and venture investing, you can roll the whole world up and it fits in just a small element of what Silicon Valley does. The ecosystem here is still the center of the venture universe. The size of the funds, the AUMs, to AJ's point, we're a rounding error compared to his fund size. And at the end of the day, that's something that doesn't occur elsewhere. When you look at, Europe is still a very challenging venture environment. I think the Middle East is actually, has been, I think, the brightest of spots. I think India is coming up, but there's a reason, that whether it's technology, whether it's financing, whether it's ecosystem, you need all of those pieces to come together to create the symphony of the Valley. And while there are going to be people that move out, this is like a great debate had in my personal household. My wife is a senior executive at a public company. She's been at all the major startups. She has been at Facebook and Uber and, on and on and on. And, some of her colleagues are exiting. And, at the end of the day, I think one of the things we've talked about internally is, her network, which allows her to go and be a VP at a public company, to a VP at a public company, is something that doesn't exist here. The pay scale that people get, the value is there. Being a female at a senior executive role is something that is challenging enough anywhere in the world, but is, far more reasonable here in the Valley. There are all these, jokes or issues how founders aren't highly diverse. I remember a couple of years ago, I was literally sitting in a panel at a venture event when a reporter asked the venture panel why we are not more diverse in venture capital. And I remember looking down the panel, and there were 2 members that were from South Asia. There were 2 members from China. There was myself, being a first generation American. There was a Latin American on that panel and a female entrepreneur. And I looked at them and said, if you can figure out a way to make this panel more diverse, please let me know. So, we're really, emboldening and embracing just everything. And there's a reason why 1% of the top talent in the entire world is trying to get to Silicon Valley.
Yeah,
I think that's true.
I think we're happy to share like a little people who are moving out have a little more space in San Francisco. I think getting to that breathing room that AJ mentioned is not a bad thing.
Well, that's terrific. So we're about 35 minutes in to our 60-minute panel discussion. And what I'd like to do, because we've been speaking about some issues generally, is it's very rare that you get a panel with some diverse expertise. And what I want to do is have each of you talk a little bit about what you see coming down the pike in your particular area. So Carolyn, I think that, maybe in the energy industry and infrastructure, if you could start us off with what you see coming down in 2021, we'd appreciate it.
Yeah, maybe starting off with some numbers of, for example, just how the energy generation has changed and continues to change. Everybody maybe think through what would you expect is the planned utility scale electricity generating capacity that will be built out this year. How much of that do you think is going to be from renewables? And quick answer, it's going to be about 70% renewable. So 40% solar, 30% wind, 16% from natural gas, 11% from batteries, and 3% nuclear in the US. So we're seeing kind of that transition to renewable is just happening. It's unstoppable. There is no, there's no debate about that. I see battery energy storage just going up more over the future, but that's the course. Another trend in our space, in the broader kind of energy and including mobility area, is we have all these SPACs out there. Some of them in dire need, looking for targets to buy out. So there are, I think, 26 mergers were already happening in 2020 on the EV electric mobility side, and a number of more out there. So that will continue driving kind of the electrification of transportation faster into kind of 2021 and the future. And then just mentioning the new administration yesterday already passing an executive order restoring some of the climate and science and the Paris Climate Agreement for kind of the as the biggest name, but kind of that transition. If you're an entrepreneur out there and you're in the space this year, I think it'll be a terrific year. Additional ESG, I think, is going to continue. Carbon monitoring, carbon capture, those technologies will be in big demand. And lastly, everything that is just very data centric, and I mean, of course, using AI and machine learning, continuing to do that. But I think just having kind of ways to capture and collect and monetize the data around energy.
So what I'd like to do is I want to come back to ESG in a few minutes, because I think there's some interesting things to kind of probe and discuss there. But before we do, F, what do you see coming down in 2021 in your neck of the woods, in your world?
Yeah, so we're a little more diverse in terms of in investing. We're a little broader across this technology, health, and wellness space. We've been spending a lot of time over the last couple of years in agriculture technology, CPG food products, even into the extension into the regulated cannabis and hemp categories there as well. We see that paralleling a lot of the other advancements here in Silicon Valley. you know, we just see it continuing. You know, we were really blessed as a fund to have been in categories that boomed during this particular downturn. You know, food has been a huge category. People have decided to get healthier, which is great. We had a telehealth company, which, you know, shockingly has been sold twice during this. You know, the first time around, it was sold right before the pandemic, and, you know, it was purchased by a private equity firm. You know, we probably could have gotten 5x more, you know, if we had just waited 3 months, but then they sold it again a couple of weeks ago, and we ended up getting our 10x, although on a smaller percentage scale. So, you know, it's been fine there. I think what you know, we are seeing is two factors. One, you know, this pandemic as a whole has exposed a tremendous amount of opportunity, which is what we're supposed to be doing in venture. You know, finding the white spaces and the green fields in different categories. I think the healthcare industry as a whole has exposed just a tremendous amount of weak links there. You know, traditional ways that consumers are, you know, engaging with entertainment, with food, with delivery. You know, to me, this reminds me of the e-com boom that happened 4 or 5 years after the .com collapse. So there's a lot of things happening there. You know, for us, as we look at food and ag, you know, meal delivery, Instacarts, all of these categories have become just far more relevant there. A lot of on-demand services. People have broken down a lot of the aversion to many of these things there that are very helpful. And then, you know, to Caroline's point, the resurgence of clean tech. I mean, you know, we kind of swore that off, you know, with the last downturn, but, you know, we're starting to see deal flow again. We're starting to find ways that, you know, that make sense in a lot of real-time scenarios. So, you know, these are some strong categories. And, you know, traditional tech is traditional tech. If you can find a white space in enterprise and, you know, get your product in there and generate revenue, you know, you're gonna grow or get bought.
So it sounds like many of your portfolio companies were, this is a great opportunity that presented itself with regard to the pandemic, or at least not necessarily great, not that the pandemic was a great opportunity for them, but it led to the ability for them to accelerate some of their growth and get a good return. And I guess you and I were talking earlier, we're going to be in the pandemic probably for a little while yonder, at least here in the United States. So because of that, throughout most of 2021, you know, they'll continue to have gasoline on the fire, if you will, right? It'll continue to accelerate.
Yeah, well, I mean, just some of the data we heard, just to give you an idea, in the state of California, they're anticipating we won't even get to 65 or older vaccinations for the next 22 weeks minimum. Okay. And then globally, the data that's coming in from around the world is we won't have any max vaccination globally till 2024. So this is going to be a consistent problem globally for the foreseeable future. So, you know, the way that people have changed is there. You know, when does the roaring, you know, 20s sort of experience kind of post-Spanish flu, the first time around with the pandemic, you know, that's probably going to have to wait for a bit.
AJ, what do you see?
Yeah, so, you know, we there are lots of things and opportunities that are opening up, and you know, there are sectors that we don't even invest in. But let me just talk about a couple of areas that we do invest in. I mean, one is the massive acceleration of e-commerce, and basically, you know, in the period between April and June, in 3 months, the e-commerce volume went up by the same amount that it did in the prior 10 years in percentage growth. Okay, so 3 months, similar to what happened in the prior 10 years. So I think many people were experiencing, you know, e-commerce, unusual e-commerce that they didn't experience before. Some of the things that F mentioned, like, you know, food delivery and things of that nature, that penetration has gone up massively. If you look at DoorDash's numbers and so forth. So I think, you know, that is one trend, and that's not going to go back, whether the pandemic lasts at 2024 or not. I think people have just become used to that behavior now, and are, you know, that's, some people might go back, but a lot of people just going to keep doing it, right? And so, you know, so I think that's a fundamental change that has happened that's going to open up lots of opportunities, where that's a fundamental behavior change that entrepreneurs should be able to leverage, right? So that's on the consumer side. On the B2B side, somebody was mentioning this morning that, you know, there's like $1 trillion worth of infrastructure that is sitting around globally, right? And only 6% of that is transformed into the cloud, right? So that opportunity in every area is kind of like mega, because eventually people are not going to have that on-prem, and it's going to happen very slowly, but it's a massive, opportunity. The third thing I would say is verticalization of SaaS. So, in every area, whether you look at healthcare or fintech or insurance, software companies, instead of providing software to the current incumbents, are actually competing using technology with the current incumbents. So if you look at Lemonade for insurance, or Livongo in healthcare, or a firm that just went public, or Chime for banking, right? One of our companies, Earnin. I mean, these companies are replacing incumbents and competing with them directly by being technology enabled and using data, particularly data, as their differentiation. I mean, I'll give you one example. We're in a company called Harmonize Health, which provides healthcare to the Medicare population, and they're able to monitor these patients at home, and they're collecting so much data and combining with EMS data now that they're able to predict when an event's going to happen. So imagine being in a situation where you're monitoring an aging population that has multiple comorbidities, and you can predict when they may have, let's say, a heart attack or a stroke, right? So these types of things will enable these technology-centric companies to basically become replacements for those organizations that are providing those services. So I think software is in fact eating the world. Okay, I mean, I think it was Andreessen that said it many years ago, and it was not evident, but now it is very evident, right? If you look at what's going on. So, and I mean, I'm so excited about Carolyn's areas, which we don't have expertise in, unfortunately. But she didn't mention hydrogen, but I keep hearing about hydrogen more and more, how it's going to be, just kind of like game changing, right? So, and then, by the way, we didn't even talk about space technology. I mean, what's happening there? With what Branson did, the other day with a rocket launching from the wing of a 747 aircraft and launching satellites as a secondary thing. I mean, that's stunning stuff. That's all privately funded. It's all entrepreneurs, and investment dollars coming together to do like absolutely stunning things, right? So, I mean, this is I can't think of another time where entrepreneurs, like anybody working for a big company, they got even an entrepreneurial, iota of entrepreneurial spirit in them. They should step out and take the risk, okay? Because money is plentiful, ideas and technology evolution is at a faster pace than ever before. And with all the negative stuff that happened with the pandemic, and it's horrible what happened with the pandemic, innovation has actually picked up pace, which is just, it just shows the human spirit and the spirit of entrepreneurship that exists globally, by the way, that, it's exciting, it's thrilling, to see that.
Yeah, I'd love to just add to what AJ said. This is the greatest point. I love to riff on this when we do panels. This is the greatest time to be an entrepreneur. There are so many options in terms of accelerators, incubators, micro funds. You literally, until the pandemic, I mean, startups were recruited and were making decisions on which, accelerator to join here in Silicon Valley based on the quality of the food and the snacks and the office space, right? So this is a great time for an entrepreneur, and that extends, right? And there was some discussion about Europe, and maybe Carolyn could speak to that to a degree, but really all around the world, we've got these accelerators and incubators and belief in this. And, places like Europe where, it was incredibly hard to find venture dollars, even 5 years ago, let alone incubators and accelerators, has really changed, right? I was, talking to one of our folks in Dubai the other day. They're spinning up incubators and accelerators. So wherever you are, great ideas can come forward, and ultimately they all sort of trail to the valley. But this is a great time to get out in front of this one. It's a great time when you're in this pandemic because the bar is low in a lot of ways, and when we come out of it, can you be shot out of the rocket?
Totally agree. And it's like incubators spinning up, virtual incubators across the globe, and I think that kind of rises the bar for maybe the local ones, and so the whole ecosystem is kind of improving. And those incubators and accelerators are sometimes, I feel sometimes a little dismissed by entrepreneurs, but they are also part of that ecosystem of trusted partners that we all rely on, that we all listen to. So if they choose and if they dedicate time and make introductions, then we will have more open eyes and ears on them. On the topic side, AJ, hydrogen, I totally forgot about that. This is coming this year. Actually, Europe and especially Spain, Portugal are on the forefront there. An area that will sadly also be coming back to us, and we see kind of machine learning AI in terms of SaaS verticalization helping our wildfires. Last year was bad. This year is likely going to be very bad as well. So helping with predicting what is going to happen, not just on the fire side, but on like where do companies need to replace poles, or how do electricity systems need to be hardened. Kind of our universe of interacting with climate change needs to become a lot more intelligent, and software data, satellite data, space tech can really help with that.
And earlier, Carolyn, you mentioned ESG, which is environmental, social, and governance. That has been trending up for the last few years. I mean, 10 years ago it was basically non-existent. What do you see on the sort of 2020 and beyond in terms of its relevance? I think I know the answer to that. And is there anything specific coming down the pike in 2021, either on the company side or on the venture side?
Yeah, I think on the ESG market map as a broader picture, there's a drive to just understanding more what is going on, track data. So I think you can kind of bucket it into kind of 3 different areas. So collect the data, how are folks performing? That is partially actually driven by the finance world. Funds themselves or investors really wanting to see how organizations are performing on a economic, social, and governance perspective. That is actually becomes pretty complex if you want to track emissions, for example, not just like on the end use of your products, but really throughout your whole supply chain. And that's where a lot of public companies are driving the charge, and some regulation in Europe. Here, companies like Microsoft and Amazon are really kind of leading the charge on that end. Then there's the way of like improving and implementing kind of implementing ways to kind of get better here. So you can think about technologies that actually improve your footprint. So tracking is the one part, but then making changes within the organization or using different technologies. That's also where a lot of startups can come in. And then the last is kind of how do I put this? In hindsight, you couldn't improve your own systems yourself. Are there technologies for kind of third-party external mitigation? So especially on the carbon side, can you capture carbon from the air? We've seen a lot going on around kind of forest and soil carbon capture. I think there is a little bit of a bubble at this point, where technologies are not as advanced, and ways to really make sure that we're not buying into unproven methodologies. So there's still a little more research going on that kind of tail end. But yeah, but all these three buckets are currently in need and required by customers who are paying money for that, and consumers as well, like Stripe implementing kind of ways for you to give back or kind of make purchases that are carbon neutral. Shopify is doing that, I think, as well. So it's interesting. Everybody can also, not just VCs, but every person on their kind of personal behavior, make a selection with their own dollars of where they want to spend and where they want to have an impact.
AJ, any additional thoughts? I mean,
No, I totally agree with that. I think that my personal view is that the movement is too slow. Okay, the intent is there, but the actual movement is too slow. And I'm hopeful that the new government will, put more sort of definition around what responsible corporations need to do in each of these three areas, right? So we try to work with our companies, particularly the ones that, in any year we have 4 or 5 companies that are looking to go public, kind of like make sure that they are, because they're getting to a scale where it's going to matter, right? As a corporation, that they start to address, each of those areas, and try to make progress. But I just feel like it's still not ingrained in the cultures of our companies. Is kind of like my point of view, I think a lot more needs to be done. But but hopefully we'll make progress gradually in that direction is my hope. And there'll also be sort of a private government partnership to accelerate some of these trends. And I think asking that question more into pre-public companies is the right thing to do, okay? To get them situated properly and thinking about that early, right, in their evolution as they move towards becoming larger public companies.
Yeah, I mean, I echo everything my colleagues are saying. I mean, I think at the end of the day, people often don't realize how much we're fundamentally moving the ball across everything we do, right? So much of technology is if you will, sort of moving the glacier and knocking down mountains, right? At the end of the day, clean tech and changing the grid and capturing carbon and doing all these great things, and ultimately, big things in energy are really important, but those are often very hard to achieve. When we look at what we're doing at a tech level, all the way across the investment spectrum, I mean, our companies that are involved in plant-based proteins, I mean, the impact that they have, actually exceeds the ability pretty much of anything we can do as a race in clean tech today, because every single cow, every single, sort of, live protein source that we take out of the mix is exponentially more meaningful, than many of these others, because, you're talking 1 gram of protein 40 times the inputs and outputs, right? That means, when you're dealing with these plant-based proteins, and our companies are doing these things in fermentation, they're not growing them in a field so much any longer. These are done in high density, high value fermentations. That's something that, when you look at it at a global impact level is frankly more meaningful. When you look at the impact tech has when we look at e-com, when we look at delivery. Delivery is actually something where everybody thinks, well, geez, that is not furthering this cause. It actually is, because when you take in, there's a huge undercurrent, things that we invested in, 15 years ago in routing technology, which lives at the base of a lot of this, delivery technology. The ability to just, instead of a consumer going out, driving around town, going to 15 different stores, to be able to do that online, to do it efficiently. The delivery drivers using route mapping software, if they shave a quarter of a mile off that trip, we've made huge impact. And that, when it's compounded globally, is oftentimes as or more in fact impactful than many of the things we do. And I'm not trying to minimize, clean tech's investment. That's the tip of the spear, right? But I don't think we should minimize, just how much tech is really helping that cause along. And whether that's, delivery, whether that's e-com, I would much rather, instead of every consumer going out to their local mall and driving around all day to pick up 20 items, at the end of the day, Amazon running on electric vehicle delivery with high quality route mapping is actually way more efficient, and when you extrapolate this globally, it makes a huge difference. The issue to me is, how do we extend that technology? How do we bring that into the underserved markets, first in the United States and North America, but really globally, right? You've got emerging markets in LATAM, emerging markets in Africa, certainly the country of India, being able to grow that. And that may have to happen from the outside, because there's a lot of blockers inside. There's so much of the world that, just needs to get that mobile device, that needs to get e-com, that needs to get, digital wallets, not currency per se, that can come in as well. But, these are things that have, massive global impact. People don't think about it, but, just making these fundamental changes will have a huge impact.
Well, I think that basically wraps us up to the hour. But before we transition and take audience questions, what I'd like to do is allow each of you sort of a 30 seconds or so just to make a prediction, or give some thought as to, share some thoughts as to what specifically you see coming down in 2021 in your area, and then in your sector, and then also reiterate your contact information if you want to be contacted. What's the best way to get in touch with you? So I'll start with you, AJ, and then we'll go Carolyn and F.
Yeah, I mean, I think 2021 is going to be a banner year in venture. I think all the right stars are aligned. I think the momentum is there going into the year. I think a lot of people, at a personal level, while they were staying at home, lockdown or what have you, did personal soul searching as to what they want to do with the rest of their lives, and how do they make an impact? Not just
reading my diary, AJ.
Sorry?
You've been reading my diary.
Yeah, it probably has probably been leaked, unfortunately, but
yeah.
But yeah, I think people have been, so I think they've been thinking about what they want to do with it. They look at the opportunities outside. There are many more examples of entrepreneurs that have stepped out and done amazing things. I mean, think about the Zoom founder, right? So Eric, so and all the core infrastructure in the broadest sense is in place to do that. So I predict a banner year in terms of entrepreneurship, innovation, globally, by the way. I mean, I forgot to mention, I'm originally from India, by the way, and the entrepreneurial ecosystem there is now, I would say, fully mature after many, many years of sort of going sideways. So great exits there, great amount of money being invested into that country, and it's happening globally. So I think, I think it's going to be a banner year. It's going to be a stunning year for entrepreneurs.
Terrific. And the best way to reach you is on your Twitter account, did you say?
Oh yeah, on my Twitter, @AjayChopra.
Terrific.
You can just DM me.
Great. I guess I'll go next. I think, agree with AJ. It's going to be a banner year. I think we'll see some overcompensation in terms of people wanting to travel and wanting to be out in the world once they can again. Sadly, that will likely be in the more developed side of the world and countries that have secured high number of vaccine. But those trying to get to wherever they can. So travel picking up quickly once that happens. People, I think we'll see a more investment in physical infrastructure. So infrastructure that probably is driven through some government programs. And I'm hopeful that startups and technology and to help what we're also seeing with the vaccine rollout right now, startup companies and technology helping and trying to get into the right spaces to make all this more efficient. And so maybe, and that's probably more hope than prediction, that these infrastructure projects can get onto the ground faster, if it's energy a road or just general like build out of physical goods, that I'm hoping that the technology, SaaS data will help make that happen more quickly. And then on my personal, the area I'm most looking at is industrializing the way we're dealing with renewables. So really increasing efficiency on projects that are out in the field for wind, solar, batteries, EVs, EV charging, just driving the efficiencies up together with new installations, but what's already out in the field, make that really be top-notch and comparable to other older, more traditional industrial infrastructure that we have out there. As mentioned, you can reach me on through LinkedIn, Carolyn Funk, or email carolyn@bluebearcap.com. Thanks for joining, everyone.
Yeah, just to it's hard to add much to what my esteemed colleagues have said here. I think it's going to be a banner year. I mean, I think, venture folks like us are really pattern matchers. Everybody thinks we've got this amazing crystal ball behind the scenes and we're, able to see the future, but really oftentimes we're pattern matching. So we look back, and I judging from my backstory here in Silicon Valley, I look back to patterns when you've got a change in administration like this, particularly to the Democratic side, particularly to the interest around some of the new categories or historic categories, re-entering a much more meaningful world stage. We've definitely seen a technology boom happen within this with this particular environment. Also, we're going to have a significant lift from the public capital markets, for a while, right? You've got to remember where we get our money is from institutions and high net worth and family offices, and as long as they're flush with capital, they need diversification, and oftentimes we're a very small component of their overall investment strategy, but that's the allocation we get, and the larger and the higher performance and the larger AUM that those folks get to, the more that's allocated to us. So I think we're going to keep seeing that, and we're going to keep seeing tremendous interest in the category.
Terrific, thank you, F. And again, if I look away at any point in time during today's call, it's in part because I'm managing a bunch of the tech in the background and I'm taking some notes. So with that, I think we should pivot at this point to the Q&A section. So for the folks in the audience, I know we have a lot of people today. If you've got a question, please send it through the Q&A function. That's the best way to track it. Otherwise, it gets lost in the chat box. And we'll start moving through some of those now. So I guess one question to start with is related to the ecosystem, early stage finance, and changes that have come out in the crowdfunding regulations to allow folks to raise up to $5 million in crowdfunding as opposed to the $1 million cap before. I don't remember, it was November or so, October, November, December. Do you see that eating into or affecting at all the early stage space in terms of folks raising from seed and angels, or how does that fit?
Well,
Yeah.
I mean, at a high level, Sorry, if I can just make a point.
No, go,
While
AJ. Appreciate it.
before I forget it. You know, I mean, I think this concept of, you know, crowdfunding being in conflict with venture capital has been around, I don't know, for 5 years that I know of, right? I mean, lots of times I'm asked that question. You know, venture capital is not right for every organization, right? In fact, if you look in the US, the number of organizations that are formed, think about your local, you know, store or something on the corner. Most of them don't get venture money, or don't take venture money, or don't need venture. I should say, more importantly, should not need venture money. It's the wrong instrument for them, right? They can just borrow from the local bank and get on with it. Many people just can do that with friends and family and so forth. And so, you know, as a venture capitalist, I welcome crowdfunding because it's another avenue for entrepreneurs to get capital for the right type of company. You know, if you're going to get venture capital, you're in a way committing to the venture capitalist that you're going to build $1 billion company, right? And not all great ideas need to have that kind of exit for you to do extremely well and have a fulfilling life. Okay, so I think crowdfunding is very much one more avenue that I'm really glad that they're opening up to more than 1 million, you know, and making more capital available and so forth. So I don't see that as a conflict at all. I think it can, in fact, it can even coexist. Maybe there are some companies that are co-funded at the earliest stages, and when they need, you know, the 20, 30, 40 million dollars, they can come to, you know, people like us and talk to them. So anyway, that's my point of view, but I wanted to make sure I pointed that out before I forgot. You were saying something.
Yeah, I totally agree with AJ, and I think that's very astute what he's saying. I mean, venture is not right for most startups out there. You know, especially when you know, we covered this in a clean tech panel way back. Clean tech especially is a very hard one. It applies in some of the agriculture categories where we're at. You know, the time horizon for the building of these companies and letting them reach scale and proving out their vision is oftentimes, you know, much longer than we have in the traditional venture fund space. So, you know, there is a lot to be said for other fundings. You know, when it comes down, and I don't mean to, you know, sort of, you know, dump on crowdfunding with you know, on your side, Jason, but I'm going to dump on crowdfunding. You know, it's not a great choice. It is really a very challenging category. You know, it does more to block companies out of eventual mechanisms of investment. You know, we have unfortunately had to pass on companies we would have loved to invest in because they, you know, crowdfunding means that they have to manage a whole series of retail investors. There's a reason why the financial system exists today in the mechanism. There's a reason why, you know, we as venture folks have a day job, which is investing in these startups, right? You know, it's just not for the faint of heart. You know, being able for an entrepreneur to, you know, articulate how long things are going to take to a retail investor is very, very challenging. You know, we've seen companies that spend more time managing investors than running their businesses, you know, as a result of crowdfunding. There are a few categories with particular products that work, but, you know, if you're not putting out a new line of t-shirts that can get, you know, immediate return on investment with massive margins to work off of, you know, which is really an arbitrage story, it's very, very difficult. So I would, you know, caution against that, you know, unless all options have failed.
No, I mean, that's been my experience, and same for my clients as well. I mean, we usually cancel, you know, so I don't work in the crowdfunding space. I only work in the venture space. And up until this point, it's been mutually exclusive to a certain extent, insofar as the amounts of money you could raise, which were only $1 million, were not enough to justify all the expenses and information that you have to provide to all your investors on the cap table. So it just hadn't been a good fit. Maybe that'll change.
And going to 5 million just 5x's that burden on the entrepreneur. I mean,
yeah,
part of the whole, you know, value in venture, other capital is they can spend their time building their business with a, you know, constant but you know, sort of lightweight reporting structure when you compare that to retail investments and applying almost like a public market disclosure component to it.
Yeah, I mean, there have been some other changes that are happening in terms of the way these platforms are set up, where it seems like there's only one investor and they're basically doing some swaps and other things to try and solve some of those issues. But I've not Yeah, I haven't dug too deep into that, and so I don't want to get outside of my wheelhouse. Sounds like AJ, you've seen that. Some of those.
No, we have actually not run into that a lot, to be honest. I mean, I've seen that on the fringes, but
Yeah.
not really. Yeah.
But that's a perennial question. I'm glad it was asked. I think it's important for folks to keep in mind. Here's maybe a more targeted one for Carolyn, which is, what are your thoughts on the future of nuclear? It sounded like, what'd you say, 3% this year in the US, nuclear?
Yeah, that's a project that's already kind of approved and going to become commissioned this year. I think there is exciting there are exciting developments around smaller scale nuclear, more distributed type of nuclear, and that I think have merit. And there's interest, and there are for sure also investors focused on that space. I will say that having that background from Germany, like in some parts of the world, nuclear, just the term doesn't really fly anymore. So you have to be very specific on where you locate, if and when you build a company around a technology. Just the general public doesn't understand the nuances between different types of reactors and such. And so there will be opposition in some parts of the world. But I think from a technology and energy efficiency and climate perspective, there's super interesting developments.
Mm-hmm.
So unless anyone else has any other thoughts, I was going to pivot to another question. Okay. So there's a question that relates to, I think, basically the various stages that a venture-backed company would go through, which is kind of at what point in your life cycle are you seeking seed versus your Series A, and more specifically, the question is, can a stellar prototype attract investment, or is a full MVP the minimum? So maybe someone could just walk us through a little bit at a high level, kind of the typical path in terms of angels, seed.
Yeah, but I'll do that from my own experience as an entrepreneur, and see if that resonates. So, I did, when I was 28, didn't know anyone, and this was in the era when, information about venture capitalists was nowhere near where it is right now, in terms of availability. So it was very difficult, and I leaned on my legal counsel at Wilson Sonsini and other people that I knew, literally to get to a couple of wealthy individuals. Like, that's all I was able to do through all the connections, and knew that, like, it was a do or die. Made a pitch to them, was able to get one of them to commit. Okay, like literally there were, I think, like 2 or 3 that I spoke to. And then that person introduced me to his buddies who were wealthy, right? And I was able to scrape together $250,000 as the very first amount of money for the company. And sort of went from there. And then because those people had made a commitment to the company, they had an interest in seeing that it'd be successful. So they would introduce me to their connections in the venture community. And for the first time, I got to know that there's even Sandal Road, okay? And where most of the VCs hung out at that time. And then started to, figure out that there's actually seed investors and early stage, and all this stuff was not very clear. And by the way, that's very typical for a lot of entrepreneurs even today. But what I want to say is that from my time to now, that has completely changed. There's tons of information available on every venture firm. If you go to Crunchbase, or if you look at, just kind of Google and search for like early stage venture capital. I mean, the people like you, Jason, who may be able to advise and very early stage folks on how to connect and make those connections. So my advice would be
their Twitter feed.
Oh, by the way, there's Twitter feeds. Goodness, I didn't have Twitter in my era. Like, I'm dating myself now. So I think, so there's so much. The last point I want to make before I let others speak to this is that, I'm constantly surprised at how little research a lot of entrepreneurs, not all, but quite a few entrepreneurs do before they approach me, right? So, I mean, it's very easy to find out what areas we invest in. It's very easy to find out if there's a competitive investments. I'm surprised how many entrepreneurs send me their, PowerPoint for a company that is directly competitive with something that I've just invested in. Like, how does that make any sense? We just don't do that. Like most VCs don't invest in competitive companies. A few do, but they try to do Chinese walls and all that. But we don't do that. So I think doing your research, being introduced through connections, through LinkedIn, you can find all kinds of connections that maybe connect to the right VC. Figuring out the 3 or 4 or 5 venture capitalists that are most likely to be interested in what you're doing, right? If it's energy, it's Carolyn. If it's ag tech, it's F, that kind of stuff, right? It's easy to find. It's very easy to find who those are, and then figuring out the connections through them, through LinkedIn and other ways, is much easier. So do that work first, and you'll be rewarded. I think this blind, sending your plan to lots of people and hoping somebody to hit is just like a wasted effort, and also a disappointing and disheartening effort for entrepreneurs, right? You may have a great idea, but you're executing wrong on the fundraising, so you may actually not be able to make progress with that idea because of lack of funding, and I mean, you've now sort of done some harm not just to yourself but to the entire ecosystem, right? So that's my point.
I don't know if we want to go more into the numbers. I totally agree with AJ, and it's like there's a lot of research that can be done on both sides before kind of spending time. And just because we're sitting in front of our computers all day doesn't mean that we necessarily have to talk with the whole world, and can have a better filters initially. But I think from my perspective, if you have it's different back to your question, Jason, what levels of kind of business traction do you need to have? I think the round numbers and letters and names that probably Jason is seeing, as well as the other of us here on the panel, if it's like a seed 1, 2, 3, pre-A, A1, 2, 3, A plus, pre-B. I think you can categorize things in that manner. But I think for us at BlueBear, we're looking for companies at a seed stage that have real customer engagement, that might be pilots, that should be paid pilots at least. If you have first kind of product sale, that's great. But there's like something in writing with customers. Everything else is too early for most seed investors, and you should talk to your friends and family and angels. And then for Series A, I think aiming for $1 million in revenue. If you have ARR, that's great. Kind of taking that as your benchmark. And then if you go to Series B, I don't know, 5 million. Just to put out numbers, and that is all depends on the space, depends on the kind of hardware, software markets that you're addressing. So take it all with a grain of salt.
Yeah, and I would just add on to that. I mean, unless this is your third venture-backed funded startup, coming to folks like us with, an idea stage company is really going to be a very rare win, right? I mean, look, I wouldn't rule it out, but to AJ and Carolyn's point, know who you're going to in terms of a VC. The number one thing we look for is customer feedback. Your number one validation point is, how much customers want your product. I mean, the more rabid your customers are, the more interested we are. Coming to us and telling us your customers are going to want your product has very low value. Your customers coming to us and telling us they love your product has got all the value in the world.
If I can steal a phrase that you said earlier, it's prove that the dogs will eat the dog food. And then
I didn't make that up. That's probably
I know.
not appropriate culturally for the animal world, but
I'm a dog lover. I'm a dog lover, and my dog's food is very important. So
unless you're an actual dog, I don't know if you're allowed to say it, Jason.
All right, fair enough, fair enough. Um, let's see. In terms of, there is one question. So we did go into like, what are your particular areas of focus or sectors? But I don't think that we did a good job framing or articulating geography in terms of, you know, which deals you'd look at and where they are. Carolyn, I think everybody in you articulated Europe and the US, but if there are you know, if you are geographically open outside of that, please let the viewers know where in the world you would be willing to do a deal.
Yeah, so for us, it's also not all of North America, so US and Canada.
Yeah, we're North America focused primarily, but you know, we have, as I mentioned earlier, we have worked with companies in Israel, India, France, Germany, UK, companies that have the potential of building products that would have global, you know, global interest, particularly in the SaaS domain. And we have helped them sort of become global companies by moving to the US quite successfully, actually. So that would be, that happens not at the seed stage, by the way, it'll be a little bit later. So they have proven the concept and got some traction, and the product is getting some momentum. So, you know, so that's something we do as well.
Yeah, I mean, we tend to be really market focused, and you know, really the challenge we see out there is, you know, the number one market, you know, whether it be consumer, business, etc., is unfortunately North America, or fortunately, however you want to view it. You know, being able to do business in foreign markets, Europe, Middle East, you know, what we look at as EMEA, you know, Asia, there are some options, but you know, very challenging to work in. You know, those markets are not big enough. I mean, you know, most of the startups we work with, until they're, you know, C-level or beyond at this stage, we don't even tell them to look at Europe. I mean, you know, the regulatory environment, the language barriers, you know, it's trench warfare on a country to country basis for a lot of that. You know, really, you know, cracking the code and getting to scale, unfortunately, happens in, you know, North America today. And so, you know, that's where startups really need to be. If you've got another business that involves, you know, very specific, you know, geographical market issues, and you can get to a scale that's meaningful, you know, that's great. But otherwise, it sadly is a North American story more often than not.
So we are almost out of time. And before we go, I'd like to give each of you one more opportunity to reintroduce yourselves, provide your contact information, and share with the audience any thought that you have or that you'd like to share. And then after that, we'll bring the matter to a close. So AJ, I don't know if we had you lead off with anything today. Maybe we did, but we'll have you go first if that's okay.
Yeah, I mean, you can reach me at Ajay Chopra, which is my name, first name and second name, on Twitter, and just DM me. Yeah, I mean, I'll just reiterate what I said earlier, that this is a terrific time to be an entrepreneur. All the stars are aligned. So take that opportunity, come up with an idea that you are really passionate about, that hopefully relates to experiences that you've had. You know, many times, you know, the best ideas come from problems that you see in the world around you, right? Maybe in the job that you're at today, in an enterprise job, you see an opportunity that is a SaaS opportunity or an infrastructure opportunity. Or, you know, you're a consumer and you come across some interesting thoughts on how to do things better. So, I mean, just make sure it's differentiated. I often tell entrepreneurs that your time is way more expensive than my money, right? So, because remember, your time means opportunity cost. You come up with an idea that is half-baked or not sufficiently differentiated to become a large company, then you've wasted that period of time from your life, whether it's 3 years or 5 years. And that opportunity cost is massive, right? Because life is only a finite number of years so far. Maybe somebody will figure out to change that. But, you know, so I think your time is way more expensive than, or precious, I should say, than my money. You know, venture capitalists are used to losing money on one or many deals in a given year. So, so just be mindful of that. But hey, do your own work and diligence, get passionate about something that really excites you, and step out and do it.
Thank you, F. Oh, you're on mute, sir.
Sorry about that. Yeah, I echo everything that AJ said. I mean, this is the greatest time to be an entrepreneur. Certainly next year is going to be very exciting. You have no distractions if you're in, North America, because you can't go anywhere. So, take care of your family and build your business. You can't go to the movies right now here in the US safely. You can't do a lot of things, pour that into your company, which is the key. I'm going to have to sign off now. Unfortunately, I've got to go help one of our companies on a board call, and that's our day job here. So it was great, everybody. Great panel. Thank you so much, Jason and Rob, and look forward to seeing everybody again soon. Be well. Take care.
Take care.
Right. In the last minute, maybe just 2 sentences. It's a great timing. We have to be an entrepreneur. We have about 8 or 9 years left to figure out climate change. If you have an idea in that space, and figure out how to build a diverse team, I think you will have a lot of open doors to get to funding, and yeah, it's kick it off. It's urgent, it's important, and people will listen to you. So make the best of it. And then reiterating what AJ and F said, don't spend your time on Netflix, build your company. And we'll not spend our time on Netflix and review the investment and write quick memos and make it happen.
Well, thank you, Carolyn. And this brings us to the end of today's program. I want to thank Rob Lau at Idea to IPO, Ephraim Lindenbaum at Advanced Ventures, AJ Chopra at Trinity Ventures, and Carolyn Funk at Blue Bear Capital. My name is Jason Putnam-Gordon. If you need to reach me, jgordon@polsinelli.com. Thank you very much. We'll send you the presentation to the audience. Thank you very much. And we will send you today's video later this week or early next week. Take care. Goodbye.
Thank you.
Thank you.